What is up, investors? Today, we're going to take a look at the 5 reasons why I think the stock market could be headed towards another downturn. Let's take a look at reason number 1 is the housing market is showing symbols of 2008, 2009 crisis level type action. So back here, this blue line is represented by the home price index, kind of a value of homes. And we see here it started peaking in 2004, 2005, 2006, and then it peaked out in 2007 and 2008. And you guys know what happened during that time frame. The stock market and home prices came crashing down. This orange line is the consumer price index. It's kind of an index of all prices good. You see this steadily rises, which is probably how most prices should go. But home prices, along with stock prices, tend to form these bubbles. And this is what happened to homes back during the last financial crisis. Now we see home prices traded very low here, and this was probably a great time to buy a house. And now we see this form again, this divergence between the consumer price index and the national home prices is widening to a level that we saw here. So I think this could be a symbol that the housing market is starting to top out, and that to me would lead to a decline in stock prices. Next thing we have unemployment, 90-day mortgage delinquency, and bankruptcy filings. This is kind of a combination of a number of different things here, but this red line here is 90-day delinquencies on mortgages, and we see here it's actually pretty low, and that is because the government passed a law that you could not foreclose on people. I think we're going to see record foreclosures over the next 12 to 24 months as those rules and delinquencies and bankruptcies and evictions start to happen once the moratorium on these types of things run out. We see here in this orange line, this is bankruptcies. We see also this trended down very sharply in the beginning of this year as well. That could be for a number of reasons, but one could be bankruptcy lawyers are not open or have so many clients that they are not able to handle them all. Or even more importantly, a lot of courts around the country have been closed and have only been doing the most important business, and bankruptcies are probably being delayed as well. We see this blue line here represented by unemployment, and we all know that that has skyrocketed. And we see the last time it skyrocketed was back in this 08, 09 time period. This is when mortgage delinquencies started to trend up. Notice how low they were right before the financial crisis, and notice where bankruptcies were as well, and they quickly moved up as unemployment started to rise. I think anybody can realize as unemployment rises and stays high, bankruptcies are going to increase, and delinquencies and foreclosures on mortgages are going to increase. And I think the actions by our government has put a temporary Band-Aid on these things, but that Band-Aid is going to get ripped off at some point. Now, non-financial corporate debt to GDP ratio, basically the debt that corporations are taking on. We see here this 45% level has acted as a level of resistance for the longest time. 87 got very close to it. We had a crash. We had the dot-com crash back in the early 2000s. Corporate debt peaked out at about 45% to GDP. The market crashed. The same thing happened in 08 and 09. Corporate debt peaked out and the market crashed. Notice where we are here in terms of corporate debt in relation to GDP ratio. So you could, if history does repeat itself, I think you can assume that this is going to create some pressures on the market. The next reason, unemployment, as you can see, is absolutely sky high. Notice the high we made back here in 1982 and the high we made in March of 2009, and look at where we're at today. Now, some different forces going on here. A lot of this was quote unquote man-made, government forced unemployment, but we see that look how rapidly unemployment, and we can assume that this will likely improve at some point, but will it come back down to these low levels? I would estimate probably not. Now, some things happening in the United States government. We obviously are an election year, and that has a lot of different impacts on what's happening. But we have the unemployment benefits and a lot of the stuff that was in the CARES Act in relations to foreclosures and lots of different things. Stimulus for the average person runs out at the end of this month. And shockingly, the Republicans and the Democrats are split on how they should handle things. Now, you as an investor, I don't care if you vote Republican. I don't care if you vote Democrat. I don't care who you vote for. But as an investor, you have to plan for these kind of things. I think you have to plan for unemployment benefits and all this stuff having a hard date end at this end of this month, and start planning on what's going to happen when those benefits start to run out. You can also assume that the Republicans and the Democrats are going to come together and create some kind of maybe extension for the benefits, and maybe just kick the can down the road and keep giving people $600 extra a week and stop foreclosing on people. That is possible as well. And maybe the best possible solution would be that they come together and they compromise and they maybe tweak or kind of maybe come up with some new ways to handle the unemployment problem and the foreclosure problem. I would guess, just based on just casually following what happens in Washington, D.C., these two sides getting together in an election year and doing what's right for the American people are probably low. And the odds of these unemployment benefits and these things running out and having a hard date is probably rather high. So we'll see what happens with these. Obviously on YouTube, you can follow Meet Kevin or Clear Value Tax. These guys are updating you every minute of every day what's happening with these unemployment benefits. I personally would have a best case scenario, a worst case scenario, and start to plan for that as an investor. Now, what should you do in this scenario? Should you run out and go sell all your stocks? Should you just go to cash? Should you buy a bunch of gold? Should you just buy a private island and retire? I would argue maybe that last one would be a great idea, but most of us probably don't have that kind of money. But I do not, and I repeat, I do not endorse the all in, all out mentality with stocks, either being all in or selling everything and being all out.
I'm all in.
I don't think that's a great idea. But also is evidence that there's lots of dry powder in the reserves of the average consumer. The Federal Reserve is also pumping huge amounts of money into the system every single day in the form of quantitative easing, and that is driving stock prices higher. And I would never, ever want to play a game where I'm betting against the Federal Reserve Bank of any country, particularly the United States. So it is possible that stock prices continue to run just like they have in these high-flying stocks like Shopify and Tesla. But do you want to break the cardinal sin of investing, and that is buying high and having to sell low? The time to buy Tesla and the time to buy Shopify was back when they were in the $200, maybe even $300 range, not when they're at their all-time highs. So I would take a breather. I would definitely not be actively buying large quantities of stocks right now, just based on all the statistics I ran through. And on top of that, you have the government pulling the plug possibly on some very, very useful and beneficial unemployment programs and foreclosure programs that have held things together for the time being. Personally, I would wait on the sidelines. I would put some stop losses underneath some stocks if you cannot afford for stocks to crash down. Tread carefully. I would not go all in, all out of stocks, but I would look for buying opportunities in the future. I would not be buying at these all-time highs. Good luck with your investments. Leave me a comment. Maybe you agree. Good luck with your investments.